Welcome to the deep dive. We unpack complex ideas and really try to pull out the most important insights for you.
That's the goal.
Today, we're diving deep into investing. Specifically, we're looking through the lens of, well, one of its most influential figures, John C. Bogle.
Check Bogle, yeah.
Yeah.
And his famous book, The Little Book of Common Sense Investing.
Exactly. Our mission here is to explore this kind of paradox Bogle presents. What if the best financial wisdom isn't some complex secret? What if it's actually something so simple that, most people just miss it?
Right. It's about his blueprint, really, for predictable long-term returns, getting away from all the speculation.
Yeah, focused on simplicity, patience, discipline.
And it's fascinating because Bogle, the founder of Vanguard, creator of the first index fund, he essentially wrote this sharp critique of the whole Wall Street active management culture.
So not just promoting index funds, but actively arguing against the alternative?
Precisely. He was showing how low-cost index funds are, for most people, the most effective way to build serious wealth over the long run. It challenges a lot of ingrained beliefs about market success.
Okay, let's unpack that. Because I think for many of us, the default thinking is, you make money by being smarter than the market.
Picking the right stocks, timing things perfectly.
Yeah, exactly. Like finding that hidden gem stock or knowing when to jump in and out. It's the image of the market wizard, right?
And Bogle just systematically dismantles that idea. He uses decades of data.
What does the data show?
Well, it shows that the vast majority of active managers, these are the pros, the highly paid experts, whose job it is to pick winners, they consistently fail to beat the overall market.
Fail to beat it.
Especially after you factor in their fees and expenses. That's the crucial part.
Yeah.
So even if some have a good year or two, very, very few keep up that superior performance over the long haul. It kind of undermines the whole idea of expertise in stock picking, doesn't it?
It really does. It feels counterintuitive. We're sort of trained to think complexity, higher fees, that must mean better results. How does Bogle explain why this happens? Why does the expertise not translate?
Well, this gets right to what he famously calls the arithmetic of investing. It's actually quite straightforward when you think about it.
Okay.
The total return of the entire market is, by definition, the average return of all investors in that market.
Right. Okay. Makes sense. The sum of all parts.
Exactly. And active managers as a group, they are a huge chunk of the market. So collectively, they're the market average before costs.
I see where this is going.
So they can't, as a group, beat the average.
Yeah.
Then you subtract their cost, management fees, trading costs, all that.
Which can be significant.
Very significant. And the inevitable result is that the average actively managed dollar must underperform the market average. It's just math. Not about smarts, it's arithmetic.
Wow. Okay. So if trying to pick stocks is statistically a losing game for most people because of this arithmetic, what's the Bogle alternative?
And this is where his big idea comes in. The power of index funds.
The simple index fund?
Deceptively simple. They don't try to be clever and pick winners. They just aim to track a broad market index, like, say, the S&P 500.
So they own a little bit of everything in that index.
Exactly. They mirror the market's performance. Now, that guarantees you the average market return, which might not sound amazing.
Right. Average sounds.
But
Right.
because their costs are so much lower, dramatically lower than active funds, they end up outperforming the majority of those active funds over the long run.
Because they're not losing as much to fees.
Precisely. That average return of the market, compounded over decades with minimal costs, turns out to be way better than what the average active investor actually gets to keep.
Which brings us to Bogle's famous line, in investing, you get what you don't pay for. That sounds backward at first.
It does, doesn't it? But it raises a really important question for you, the investor. What are those fees actually buying you?
Performance, hopefully.
Well, as we saw, usually not better performance on average. So Bogle argued you're often just paying for activity, for the trading, for the management structure.
Yeah.
And all these costs relentlessly eat away at your returns.
Even small percentages.
Oh, absolutely. He emphasizes constantly, even a seemingly small cost, maybe 1%, 1.5%, 2% a year, it compounds dramatically over time.
How dramatically?
Think about it over, say, 30 or 40 years. That seemingly small fee can literally shave hundreds of thousands of dollars off your final nest egg. It's wealth destruction, hidden in plain sight.
Wow.
And index funds, because they're passive, they trade very little. They're specifically designed to minimize those costs. Let your money work for you, not for the fund manager.
So, okay, the mechanics are low-cost index funds, but Bogle also talks a lot about mindset, doesn't he? About the investor's behavior.
Hugely important, maybe even more important than the fund selection itself. He stresses patience and emotional control.
How do things like time and impulse fit in?
Well, he's all about long-term investing versus short-term speculation. He points out, look, the market will fluctuate, sometimes wildly. That's a given.
Ups and downs are normal.
Exactly. But historically, over long enough periods, the trend is reliably upward. The real danger isn't the fluctuation itself, it's how you react to it.
Panicking during downturns, maybe?
Precisely. Selling low when things look scary. Or the opposite, chasing hot stocks or trends when everyone's euphoric, basically buying high.
Yeah, fear and greed.
Those emotional reactions, Bogle argues, almost guarantee underperformance compared to someone who just stays disciplined, sticks with the plan. Patience and discipline, he thought, were the most valuable traits, much more than trying to be clever.
So that sounds really hands-off, like a minimalist approach almost. Does he push that simplicity idea hard?
Oh, completely. It's a direct challenge to Wall Street's tendency to, create complex, fancy-sounding products.
Which often come with higher fees.
Naturally. Bogle believed most complex strategies, frequent trading, these sophisticated products, they usually benefit the firms selling them much more than they benefit you, the individual investor.
So what's his alternative? Keep it simple.
Radically simple. His advice for you is basically pick one or two low-cost, broadly diversified index funds, maybe a total U.S. stock market fund, maybe an S&P 500 fund. Add a broad bond index fund for balance, and then you stick with them. Consistently invest, reinvest all the dividends you get, and just stay invested for decades. Don't tinker.
It sounds almost too easy, doesn't it? Like there should be more to it.
That's the beauty and maybe the difficulty of it. It leads right into what Bogle saw as the quiet magic of compounding.
Albert Einstein supposedly called it the eighth wonder of the world.
And Bogle certainly treated it that way. When your investment returns start generating their own returns, and you reinvest those, the growth isn't linear, it's exponential over time.
So the longer you stay invested,
the more powerful that effect becomes. Market downturns, volatility, those are just temporary bumps in the road. Compounding is the permanent upward force if you let it work.
And the key is just not interrupting it.
Exactly. Staying the course, ignoring the noise, the news headlines, the urge to do something, let time be your greatest ally. That's the core of building long-term wealth, according to Bogle.
Now, you mentioned bonds earlier. Is it just about stocks, or how do bonds fit into this simple picture?
No, bonds are crucial too. Bogle definitely stressed their role, mainly for balancing risk.
So stocks for growth, bonds for
stability and income. Especially as you get closer to retirement or if you're just more risk-averse, bonds help cushion the portfolio during those inevitable stock market drops.
Does he suggest a specific mix?
He offered a simple rule of thumb, not a rigid rule, but a guideline. Consider holding a percentage in bonds roughly equal to your age.
So if you're 30, maybe 30% bonds, 70% stocks.
Something like that, yeah. And if you're 60, maybe 60% bonds, 40% stocks, it's about adjusting the risk level over your lifetime, building a portfolio that lets you sleep at night.
He also made a really strong distinction, didn't he, between two kinds of people in the market?
Yes, very important. He drew a bright line between the true investor and the speculator.
What's the difference in his view?
For Bogle, true investing is about owning a piece of actual businesses. It's focused on the long term, the company's earnings, the dividends it pays, its underlying value creation. You're participating in the enterprise.
Okay, that's the investor. And the speculator?
The speculator is focused almost entirely on price movements, short-term gains, market timing, hype, trying to guess what other people will pay for something tomorrow, regardless of its fundamental value.
And he saw that as dangerous.
Extremely dangerous. He thought speculation was often disastrous for individual wealth, and he warned that the financial industry often deliberately blurs that line, making speculation seem like investing. You, as an individual, need to keep that distinction crystal clear.
Okay, so wrapping this all together, low costs, index funds, simplicity, long-term focus, discipline, ignore the noise. It really does seem like discipline is the thread running through everything.
Absolutely. That's probably the single biggest takeaway.
What's the final, most critical lesson from Bogle for you listening right now?
I think it boils down to this. Discipline beats perceived intelligence or complexity in investing. every time.
So it doesn't matter how smart you are if you can't stick to the plan.
Exactly. No matter what the market does, booms, busts, crazy headlines, the next big thing.
Yeah.
Bogle's core message is unwavering. Do not abandon your
So,
plans.
stay the course
Stay the
here.
course. That's how you harness the full power of compounding. That's how you minimize those killer costs and emotional errors. That's how you achieve long-term success. The practical steps for you are really clear.
Let's list them out.
Okay. 1. Invest mostly in low-cost, broad index funds. Think total stock market or S&P 500.
Yeah.
Keep your costs and taxes as absolutely low as possible. Fight for every basis point. Don't try to time the market. Don't chase hot stocks. It's a loser's game.
4.
Reinvest all your dividends. Let that compounding work its magic.
5.
Hold a sensible mix of stocks and bonds, appropriate for your age and how much risk you can handle.
And the big one.
Stick with your plan for decades, through thick and thin, recessions, crashes, bull markets. Just stay the course.
Yeah, this deep dive really hammers home that building wealth reliably. It isn't about trying to outsmart the market, is it?
Not at all. It's about joining the market cheaply and efficiently, and then letting time and compounding do all the heavy lifting for you.
It's a profound shift in perspective.
It really is. And if you think about the bigger picture here, Bogle's whole philosophy kind of suggests that the greatest insight in finance isn't some complicated algorithm or finding a secret stock.
What is it then?
It might just be the quiet, almost boring understanding that simply capturing the market's average return consistently and with minimal cost is actually the superior path to wealth for almost everyone.
Which really makes you wonder, doesn't it? What does that imply about how we usually think about financial genius, or this huge industry built entirely around the idea of beating the market?
Mm-hmm.
A lot to think about there.